Hi, today I'm going to explain the three of the Federal Reserve's primary tools used to manage the U.S. economy: open market relations, or open market operations, the discount window, and interest on reserve balances. First, open market operations, or OMO. This is the most frequently used tool by the Federal Reserve. It involves the buying and selling of government securities like treasury bonds in the open market. When the Fed buys securities, it injects money into the banking system, increasing the money supply and lowering interest rates. This encourages borrowing and spending, which helps stimulate the economy. On the other hand, when the Federal Reserve sells securities, it takes money out of the system, reducing the money supply and raising interest rates, be which can help cool down inflationary pressures. Open market operations are a key way the Federal Reserve controls short-term interest rates and stabilizes the economy. Next, looking at the discount window, this tool is used by the Federal Reserve to lend money to banks in need of short-term liquidity. When a bank faces a temporary shortage of cash, it can borrow directly from the Federal Reserve at the discount rate. The discount rate is typically higher than the federal funds rate, which is the rate at which banks lend to each other. The discount window serves as a safety net, ensuring that banks have access to funds when they need them, which helps maintain stability in the financial system. While it's not used as frequently as open market operations, it's still an important tool, especially during times of financial stress. Next, and finally, let's talk about the interest on reserve balances. Since 2008, the Federal Reserve has paid interest on the excess reserves that banks hold at the Federal Reserve. These reserves are funds that banks keep in reserve rather than lending them out. By paying interest rate on these reserves, the Fed encourages banks to hold on to their money, which can help control the money supply and keep inflation in check. Next, or not next, the rate the Federal Reserve sets on interest reserves influences how much banks are willing to lend out. If the Federal Reserve raises this rate, banks are more likely to keep their money at the Fed, reducing the amount of lending and slowing down economic activity. Lowering the rate encourages banks to lend more, which can stimulate the economy. In summary, the Federal Reserve uses open market relations, the discount window, and interest on reserve balances to manage the money supply, control interest rates, and maintain economic stability. These tools allow the Fed to respond to changes in the economy, ensuring that inflation stays in check and the financial system remains stable. Thanks for watching.